welcome to ECCB Connects, a weekly program produced by the Eastern Caribbean Central Bank to share with you who we are, what we do, and how we serve you. Are you having challenges repaying your loan at your financial institution? This week, we discuss the options available to you and how the non-payment of loans affects the services you receive. I have with me Mr. Gordon Julien, Country Manager of Scotia Bank St. Kitts and Nevis and outgoing President of the St. Kitts and Nevis Financial Services Association. Mr. Julien, welcome to ECCB Connects.
Thank you very much, Shamalon. It's a pleasure to be here.
Mr. Julien, we have an issue in the Eastern Caribbean Currency Union with respect to loans. There's the issue of non-performing loans being unfavorable. When we speak about non-performing loans, what exactly are we talking about?
Non-performing loans is a situation where loans become so delinquent to the point where a period of 90 days have elapsed without payment of principal and interest. And collection of that loan is in severe doubt or in significant doubt. And therefore, it's no longer prudent for banks to continue to accrue interest or recognize interest on those loans. In fact, it's a requirement of the central bank, it's a requirement of the external auditors that you can no longer recognize interest, because to do so, you'd be overstating your earnings and paying dividends and paying taxes and making decisions on what is considered to be fictitious earnings. So high level of delinquency, severe delinquency suggests that these loans are non-performing or non-accrual.
Mm-hmm. What are some of the main issues that cause this to happen, this high level of non-performing loans?
What are some of the issues that cause non-performing loans is poor on the credit underwriting practices from the get-go. So sometimes you don't have access to all the information, you disregard certain things, there's an undue reliance on collateral, the absence of a credit bureau, persons overextending themselves, or sometimes you may have done all things right from the onset, but circumstances may change. Somebody may have lost their job, there's marital disputes, divorce, you may have situations where unexpected expenses, like in a medical emergency, and those sort of things would affect or cause a loan to become delinquent or non-performing.
So you did mention that there are some unexpected situations, because generally customers, they take a loan, they want to pay back, but you know, there are those situations that unforeseen and they're unable to pay. Yeah. When that happens, is there any recourse for a customer?
I think that there are certain measures that can be put in place to prevent or to mitigate those risks. So for example, banks, they utilize what is called a TDSR, a total debt service ratio, whereby you do not allow the repayment on a loan to go beyond, say, 40–45%. So that way it creates a bit of a buffer, it gives you some extra money so that you can live off, buy your groceries, do certain things, travel and entertainment, and those sort of things. So you live within your means. Then once you've taken a loan, I think that persons need to consider protection. Protection in the event of a catastrophe. So you have a hurricane that destroys your house, it needs to be repaired, that's an unexpected expense, insurance will kick in. Health insurance, critical life or critical health, in case where you are incapacitated, you can no longer work. So those forms of protection would mitigate against persons not being able to pay their loans and fall into that serious situation of delinquency. So when you realize that your income has gone down, you proactively go to the bank and try to explore what options might be available to you. Debt consolidation, for example, right, would allow you a bit of more space in terms of changing the amortization of the loan, improving your cash flow, right? You may have some additional cash that's sitting somewhere, a family member that might be able to help you. Those things could be brought to bear in terms of preventing that loan from becoming delinquent.
So a customer having whatever difficulties, they really can come to the bank and have a discussion, see how what can be worked out in terms of repaying the loan.
Absolutely, and that is highly recommended, because the expectation is that once you've entered into an agreement with the bank, that does not stop because you've lost your job or because you've divorced or because you have a medical emergency. The expectation of the bank is that you would honor your obligation and make that payment. If perchance you realize that you're having difficulty, you proactively go to the bank and engage the bank in terms of coming up with some kind of arrangement. And they might be able to offer some solutions in terms of what options that might be available to you.
Okay. You mentioned insurance, which is highly recommended if you're taking out a loan. But, you know, we have cases where individuals, they take loans and they do not have insurance, the property is not insured. And recently we saw what happened in Dominica, where properties were destroyed. What recourse is there for persons, individuals who had loans, didn't have insurance, and they've lost their property?
If, for example, you have equity, so for example, the property might be valued at, I don't know, $500,000, and then you owe the bank just about $100,000. And you have income, your income can accommodate it, you might be able to approach the bank and get what is called an equity loan, right? So give you an initial set of funds, $50,000, $100,000 as the case may be, to repair that house, right? Or you may have some savings set aside that you might be able to draw upon to help in terms of repairing that house. But I would really encourage that, you know, having that protection maintains your lifestyle and prevents you from having to dip into your resources, your savings, or otherwise to be able to repair a property that you would have invested heavily into.
That's if the property is damaged. What happens in the case if the property is just destroyed? You have no house, but you have a loan.
Well, unfortunately, the obligation does not disappear. You still have that obligation to the bank. Banks, as a matter of practice, good practice, would insist that the security, the property that's securing that loan is in a state of, is properly insured. So, for example, if perchance the agreement, a condition of the loan is that you keep that property insured, and for whatever reason, every year the bank would follow up to ensure that the property is, the insurance is maintained. If perchance you're having difficulty in making that insurance premium, what some banks have done, as a matter of good practice, is pay the insurance on behalf of the individual and add the amount back to the loan, because the bank has a vested interest in ensuring that the security is properly insured.
We do have a high level of non-performing loans in our region. How does that impact the delivery of other financial services?
Well, it has a significant impact on financial institutions. The standard of non-performing loans is 5%. So in other words, the ECCB, and I think around the world, the expectation is that all banks maintain their level of non-performing loans at a 5% level. Unfortunately, in this region, I think we are a bit above that. And
before you go on, this percentage relates to the value of the total.
It's the value. How it's calculated really is the amount of your loans that is considered non-performing, and that is the amount that is, you cannot accrue any interest on. It's highly doubtful that you'll collect those loans, and as a percentage of your total loan portfolio. Okay. So if, for example, your loan portfolio is 100 and you have $17 that's considered highly doubtful for collecting, then your non-performing loan portfolio percentage is 17%. All right, and what it does really, it has a significant impact on banks, and it affects the bank across so many different key areas. So one of the key areas really is in terms of your liquidity. So if you have a high level of non-performing loans, it means that it affects your liquidity. You can no longer rely on a significant proportion of your loan portfolio to generate that level of cash flow to the bank. And secondly, so it's like dead assets. And secondly, what happens is that when you eventually sell or foreclose on the properties or the security, the underlying security, oftentimes you don't get the full amount. So the bank would have to write off a certain portion of that amount. So it impacts on your liquidity. It also impacts on your earnings. As I indicated to you, non-performing loans are no interest is accrued on those loans. So it means that the higher proportion of your portfolio that is considered non-performing, that proportion is no longer generating that earnings that you require. And as you know, in banking, earnings is important. That's the lifeblood. That's what sustains a bank. Nobody wants to deposit their money in a bank that's making losses. In fact,
because it means your money is not safe.
Your money is not safe. Absolutely right. So it's very important that banks ensure that their level of non-performing loans are properly managed. The third area is that in terms of your capital. As you know, capital is king. Banks rely on capital in order to grow, in order to be able to grant loans and do all the things that they need to do. When there's a high level of non-performing loans, it means that it affects your capital, it dilutes your capital, because you would have to set aside some of your capital base to support that proportion of your loan portfolio that's considered non-performing. That amount that is set aside is not earning, generating the returns that you would like. So it's a non-productive use, or is a poor use of a bank's capital. You want to be able to use your capital to grow the bank and to support investments and all the great things that you want to do in the bank. All right? And finally, when there's an issue of your capital, your earnings, your liquidity, then the central bank would definitely, you would get the central bank's attention. So it strikes at the heart of the financial health of a financial institution.
Okay. We spoke specifically about the impact on the banks or the financial institution. What about the effect on the direct effect on customers?
If there's a perception or the probability of default on loans in an environment or in a financial system is very high, then banks would price risk accordingly. So there will be a higher rate of interest commensurate with the underlying credit risk. So what it means is that borrowers in general would have to pay a higher rate of interest on loans. Nobody likes high rates of interest. So apart from the general macro picture, on a micro level, banks do what they call risk-based pricing. So if you as an individual customer, the indicators suggest that there's a higher risk of default on your loan, then over and above the general rates of interest that the system would attract, you as a customer would attract perhaps a higher rate of interest. Individually, okay. because your risk is different from another person's risk. Okay. So therefore, the price that you pay on a particular loan would be higher than everybody else. So all in all,
it costs you more to borrow.
It costs you more. Absolutely, it does.
Mr. Julien, you have highlighted that when customers do not pay their loans, the negative impact on the banks, on the services, on an individual attracting higher interest rates. What then is your message to customers, individuals generally, with respect to paying loans?
A bad credit rating can impact negatively on the customer. So what I would urge customers is really, let's change our culture in terms of how we view debts. Let's be proactive. Let's not leave it to the bank to call us to tell us that our loan is running behind. Most banks have online banking. The power is in your hands, on your mobile phones or your computers, where you can go and see exactly what is the status of your loan. All right? Make sure you understand the terms and conditions. If you don't understand the terms and conditions of a credit that you're taking with the bank, then how can you comply if you don't understand? And banks themselves have a responsibility to be transparent and to provide all the information that is required of the customer in terms of understanding the credit that they've taken and to be able to comply with it. I think that once you've done all those things, bad times come on all of us. But we can always get over it. Circumstances do change. What helps us is ensuring that through it all, we maintain a good credit rating, a good credit history, because we need the bank as a partner in order to rehabilitate ourselves and get ourselves back on track. So sometimes we have to make hard decisions. Let's not be afraid to do that.
Mr. Julien, thank you very much for speaking with us.
You're most welcome. Thank you very much.
You're watching ECCB Connects, protecting our currency, developing our region. To view any episode of ECCB Connects anytime, any place, at your convenience, check us out on YouTube or Facebook at ECCB Connects.
Here's where we end this week's episode of ECCB Connects. Thank you very much for watching, and do join us again next week when we'll be back with another program.